Welcome to the deep dive. We take your sources, we pull out the key insights, really giving you that shortcut to being well informed.
That's the goal.
Today, we're diving into Torrent Power Limited, specifically their Q1 FY26 results.
Yep, fresh off the press.
We've got the earnings call transcript, the media release, investor presentations, the whole stack,
Plenty to chew on.
and our mission to really figure out why they performed the way they did, understand the drivers across their different businesses.
Like generation, distribution, renewables.
Exactly. And maybe get a sense of what's next for them. So if you want to get a handle on a complex earnings report without getting lost in the weeds, you are definitely in the right place.
Let's do it.
So let's kick things off with the headline numbers. Q1 FY26 versus Q1 last year. How did Torrent Power do overall? What's the story from the revenue, the profit, the comprehensive income?
Well, the big picture shows a bit of a dip, actually. Their reported PBDIT, that's profit before depreciation, interest, and tax, it came in at 985 crore rupees for Q1 FY26, which is, a decrease. It's down 329 crore rupees, or about 25%, compared to the 3,315 crore they reported in Q1 last year.
25%? Wow. Okay. What about other key figures?
Total comprehensive income, TCI, that also saw a drop. It was 739 crore this quarter compared to 993 crore same time last year, so that's down 26%. And the top line, revenue from operations, also lower, 7,906 crore this quarter, down from 9,034 crore in Q1 FY25.
So definite declines across the board there. Now, the company did mention their underlying business remains resilient. That's a strong word, given those drops. What are they pointing to as the main reasons for this shift?
Right, that's the crucial question. They basically said, look, the core business is solid, but Q1 performance got hit hard by, well, two main things, really.
Okay.
First, lower power demand because the monsoon arrived earlier than usual. Second, gas prices stayed pretty high.
The classic combo for a power company.
Exactly. And those two together really squeezed their profits from selling power in the merchant market, especially from their gas plants.
Yeah.
They did note, though, if you adjust for some one-off non-recurring items. Okay. Let's talk about those. Yeah, the adjusted PBDIT was 1,044 crore. Now, that's still down, but only 14% compared to the adjusted 213 crore last year.
Oh.
So it suggests part of that bigger 25% drop wasn't from core operations. Got it. So let's unpack those non-recurring items.
Right.
What were they specifically, and how much did they swing the numbers? Okay, so in this quarter, Q1 FY26, the reported number includes a non-recurring loss of 59 crore rupees. That was from non-cash forex adjustments, foreign exchange fluctuation.
Okay, happens.
But compare that to last year, Q1 FY25. That quarter included a non-recurring credit of 102 crore rupees.
A credit? Where from?
That came from a favorable tariff order they received for one of their licensed distribution areas. It included things like carrying cost allowances.
Right. So a loss this year, a gain last year in those one-offs.
Precisely. So when you strip those out, the adjusted total comprehensive income for this quarter was actually pretty similar to last year's adjusted figure. It helps see the underlying operational trend a bit better.
That makes sense. So adjusting for those gives us a clearer baseline, still shows some pressure, but maybe more resilience than the headline numbers suggest. Okay, let's dig deeper then, segment by segment. Where did the biggest changes happen?
Well, the earnings call really broke it down into four main factors. And the biggest negative, by a long shot, was a drop in the profit they made from selling merchant power and LNG.
Okay, how big a drop?
A reduction of 333 crore rupees in contribution.
Oof, that's substantial.
It really is.
Yeah.
And it leads directly back to what we just talked about, the early monsoon hitting demand and the high LNG prices impacting their gas generation sales.
Right.
It really hit their thermal plant load factor, the PLF. That basically tells you how much the plant is actually running. It went from 60% in Q1 last year way down to just 39% this Q1.
60 down to 39%. That's a huge drop in utilization.
Massive. And it was due to lower sales, both under long-term contracts and significantly in that merchant market.
Now, I remember seeing something about an NVBN tender in the materials. That's like a government scheme to buy power, right? How did that play into this merchant picture? Did it help buffer the blow?
Good question. Yeah, the NVBN tender is meant to provide some guaranteed offtake. It started mid-March and runs through mid-October.
Okay.
So some power under that scheme was sold in Q1, but they expect the full guaranteed amount might spill over into Q2, maybe even Q3. And importantly, they only book revenue when the power is actually sold.
Not based on the guarantee itself.
No, not up front. Any payment for power that wasn't taken but was part of the minimum guarantee, that gets sorted out and booked only after the contract period ends. It's a kind of deferred recovery, if you like.
I see. So how much did they actually sell in the merchant market in Q1, including this NVBN power?
In Q1 FY26, they sold 714 million units, MUs, on the merchant market. That includes the NVBN sales. The total contribution for that was 327 crore rupees.
Oh.
And the average price they got was about 4 rupees 50 paise per unit. Just for comparison, in Q1 last year, that merchant contribution was much higher, 660 crore rupees.
Right. So almost double last year. Clearly, that merchant segment was under significant pressure. But Torrent Power isn't just about merchant generation. What about the other parts of the business, like distribution and renewables? Any bright spots there?
Yes, absolutely. That's where the diversification helps. The distribution business actually saw an improved contribution. It was up by 82 crore rupees.
Oh, interesting. What drove that improvement?
Mainly two things. First, just better operational performance. They managed to reduce distribution losses further and improve their collection efficiency.
And their loss levels were already pretty low, weren't they?
Exactly. In places like Ahmedabad and Surat, their T&D losses are incredibly low for India, like around 3%, give or take. It's really best-in-class stuff. Even in their franchise areas like Bhiwandi, they've slashed AT&C losses from like nearly 60% when they took over down to under 10% now.
That's a massive turnaround.
It really is. And the second factor boosting distribution was higher regulated returns, things like return on equity and return on capital employed, thanks to new assets being added and updated tariff regulations.
So strong operational execution in distribution definitely helped offset some of the generation weakness. Now, you mentioned new areas. I heard something about that potential expansion.
Ah, yes, Nagpur. So the public hearing for their parallel license application was held by MRC, the Maharashtra regulator, just today, actually, August 5th.
Oh, right now.
Yeah. The orders from the commission are expected in just a couple of days. So we should get clarity very soon on whether they get the green light for those areas in Nagpur.
Definitely something to keep an eye on then. Okay, what about the third leg, renewables? How did that segment perform?
Renewals also showed an improved contribution, up by 31 crore rupees.
Okay, good. Reasons.
Mostly due to getting more income from delayed payments owed to them under existing power supply agreements, PSAs, and also slightly higher plant load factors for their renewable assets.
Makes sense. Any offsets?
Yeah, it was partially offset because some newer solar projects, like a big 300 megawatt one, had maybe lower initial contract revenue or something along those lines. But the overall trend was positive.
And they have a big pipeline in renewables, right?
Oh yeah, significant. They're developing about 3.1 gigawatts of renewable projects, plus another 3 gigawatts of pumped storage hydro.
Pump storage too. Interesting.
And they're actively managing their portfolio. For instance, they won capacity in a recent CCI tender, that's the Solar Energy Corporation of India, tying up 60 megawatts of what was merchant capacity at a pretty decent rate of 3.97 rupees per unit.
So that's a concrete example of them shifting capacity from the volatile merchant market to more secure long-term contracts when they see a good opportunity.
Exactly. It's a smart strategic move to de-risk, especially given what happened with merchant prices this quarter. It shows they're actively adapting.
That leads nicely to the fourth factor you mentioned. I heard interest expenses were down. That seems like a positive financial management story.
Yes, that was the other significant positive contributor to the bottom line comparison. Lower interest expenses, reduced by a hefty 547 crore rupees.
Wow, 547 crore reduction. How?
Mostly because they prepaid a chunk of their debt. They used the money they raised from that QIP, the Qualified Institutional Placement last year, to pay down loans ahead of schedule.
Smart use of capital. Shows good financial discipline.
Definitely. It helps strengthen the balance sheet and obviously reduces the ongoing interest burden.
Okay, so pulling all these threads together, the hit on merchant power, the solid performance in distribution, growth in renewables, and lower interest costs. What does this all mean for Torrent Power's overall financial health and their future plans? What's the CapEx looking like?
Well, in Q1, they spent about 850 crore rupees on CapEx across the company. Around 350 crore of that was specifically for renewables. But they're planning to ramp that up significantly. The forecast for the full year FY26 is somewhere between 7,000 and 8,000 crore rupees in CapEx.
7,000 to 8,000 crore, that's a big step up.
It is. And maybe even slightly higher in FY27. The focus is clearly on expanding their portfolio, especially in green energy.
Makes sense given the pipeline you mentioned. What's their total capacity now?
Currently, their installed generation capacity is 4.9 gigawatts. That's breaking down into 2.7 gigawatt of gas, 1.8 gigawatt of renewables, and about 362 megawatts of coal.
Mostly gas and renewables then?
Predominantly, yeah. And looking ahead, the pipeline is huge. That 3.1 giga for renewables, the 3 gigawatt of pumped storage. Interesting detail there. 2 gigawatt of that storage is already tied up with the Maharashtra State Utility, MSEDCL.
Oh, okay, so locked in already.
For two-thirds of it, yes. The remaining 1 gigawatt they plan to use for the merchant market, likely from the same site. Plus, they have a couple of transmission projects in the works, too.
It definitely sounds like a major push into renewables and storage, diversifying away perhaps from some of the gas volatility. But those are huge investment numbers. How's their balance sheet looking? Can they support this level of ambition?
That's the key question, right? Can they afford this growth? And based on their FY25 numbers, their balance sheet looks quite robust.
What are the metrics telling us?
Their key leverage ratios were comfortable. Net debt to EBITDA was around 1.41 times, and net debt to equity was low at 0.4 times.
Okay, 0.4x net debt to equity is quite conservative.
It is. It gives them significant financial headroom, a lot of borrowing capacity to fund these green energy opportunities without overstretching themselves.
And their strategy seems to be leveraging that strength.
Yes, they emphasize focusing on more complex hybrid projects, maybe combining solar, wind, storage, where they think they can generate higher returns by using their experience in managing large, complicated operations.
Right, playing to their strength.
Exactly. And it's all part of diversifying to handle the ups and downs of the market cycles. Plus, they highlight that over 95% of their generation capacity now uses cleaner fuel. So there's a clear commitment to reducing their carbon footprint alongside the growth.
Okay, so to wrap up our deep dive today, we've seen Torrent Power's Q1 FY26 results were definitely shaped by external factors, the early monsoon, high gas prices hitting their merchant power profits hard.
Yeah, that was the main drag.
But at the same time, their distribution business showed real operational strength and improved its contribution. Renewables also chipped in positively.
Offsetting some of the weakness.
And we saw smart financial management reducing interest costs, plus a clear strategic pivot investing heavily in a large pipeline of renewable and pumped storage projects, all backed by what seems like a pretty healthy balance sheet.
A picture of a diversified utility navigating challenges while pushing hard on the green transition.
So, for you, our listener, it paints a picture of a company that's quite adept at managing different market conditions, even unexpected ones, while making these big bets on a greener future. Now, here's a final thought to leave you with. We saw Torrent Power strategically shifting some assets, like converting merchant capacity to long-term contracts. How critical do you think that kind of agility, that ability to dynamically manage your asset portfolio will become for utilities in the future, especially with, increasingly unpredictable weather and volatile fuel prices?
That's a great question.
What other opportunities or maybe even new challenges might pop up for companies that can manage their portfolios that flexibly? Something to mull over.
Definitely food for thought.
We hope this deep dive has given you a clearer, more insightful understanding of Torrent Power's recent performance and future direction.